Welcome to Bay Area Real Estate Townhall Q&A webinar. It happens every Wednesday from 2 to 3 p.m. Pacific Standard Time. The goal of this platform is to bridge the gap between consumers and real estate professionals, and also allowing them to ask any real estate related questions and answered by our featured speakers as well as our audience. Today, we are very excited to have Neal Bawa, a reformed technologist who has a love for data science as well, who turned into a national multifamily investor. He also loves educating new real estate investors through his multifamily university. We also have Marty Lefton. He is a commercial mortgage loan broker with over 25 years of experience, and he is my go-to guy when I find a deal because he's just as conservative as I am with the financial analysis prior to recommending it to our clients. Now, I also have Daniel Gatt, a residential loan broker who specializes in the most difficult and complex loan products. He has a track record of not having any loan denial in his 15 years of career. And lastly, my name is Helen Chong, and I am the founder of my real estate company, Helen, but I'm also serving as the president for Northern California chapter CCIM. My passion is really to share my experience and knowledge to my consumers as well as my real estate community. So let's start our webinar right now. Prior to this, a few people had already asked their questions. I'm trying to summarize it, and I'm going to start from the first question is, how many of your tenants expressing a need for rent forbearance or reduced rents? How are the landlords responding to these requests, if any? I wonder, maybe, Neal, do you have any experience right now already?
Yeah, I was muted. So very few so far, which has been a surprise. I expected a lot more of them to be approaching us. Of course, today is the key date. Today is April 1st. The multifamily industry has not been hit at all. I don't know of any syndicator that's lost a single dollar so far, because all of the bad stuff happened in the second half of March, and so people weren't really laid off in the first half of March. I'm expecting that about between 10% and 30% of my tenants are not going to pay in the month of April. I expect that number to go up in the month of May. But if the number of cases is going down because of what I call the hammer, a lockdown on a nationwide basis can be referred to as the hammer phase. And then the phase beyond the lockdown, when we come out of lockdown, is now referred to as the dance. So given that all of April, the entire month, is the hammer, I foresee that if the hammer goes well and we're seeing a large reduction in the cases, and the public knows that and media is talking about it, then we may not see a big increase in May, but that's the best case scenario. So I do expect to see an increase from that 10 to 30%. Why do I say 10 to 30%? Because my properties are all reacting differently. I have one property that's near Atlanta Airport, and the airport, it's the largest in the world. It's the busiest airport in the world. They have over 130,000 employees. A massive number of them have already been laid off. So as a result, that property looks like it's going to be in that 30% non-payment range, where there's other properties where we might even be lower than 10% non-payment for April.
I see. So would you say that most of your properties are in particular class? Would it be more class A, class B, or class C?
So I have class B and class C properties. So I'd say 2/3 of my properties are class C. And I feel that the impact in the month of April will be very strong on the class C side, not so strong on the class B side. I mean, an average class B tenant has $2,000, $3,000 in the bank. They're not as panicked. An average class C tenant has $400 in the bank. So they tend to be affected almost immediately, not just by a layoff, but also by a reduction in hours. Granted, there's all this money coming from the government, but they don't have that money in their pocket yet, right? So until they have the money in their pocket, they're not really going to believe that they can pay rent. And so I do expect the class C properties to see a significant impact.
I absolutely agree with you. From what do you think about like being out of states compared to the market here in the Bay Area, though?
So the Bay Area tenant quality is a lot better, even though California is a very tenant-friendly state. So I expect that in the month of April, an average property in California will be less hit than an average property in other states. Now, keep in mind that if your state is very landlord friendly and hasn't already declared that they will, not do evictions, then those states are going to do well. In Arizona, we're not seeing much of an impact at all. I have a property in Tucson, and it looks like we're going to come in at less than 5% delinquency for the month of April. Whereas in other states like Chicago, I'm expecting to be over 30% of the tenants not paying me, possibly as much as 40% of the tenants not paying me in Chicago, because that has always been an extremely tenant-friendly place, and they've always been the sort of audience that likes to take advantage of these sorts of things. So I think it's going to be state by state, but I do not expect California to have a huge negative reaction in April.
Good point. Good point. Now, next question, it says, what are some of the lending guidelines changed due to the COVID-19, especially, if our clients need to use RSU for their income qualification? Daniel, I know we're working on a deal right now, especially with this. What are your thoughts?
Yeah, for the most part, I'm not really seeing a tremendous change in guidelines. The guidelines are remaining mostly the same with, verification of employment. They're tightening that up as far as, trying to verify. Some lenders are doing overlays, which an overlay means that Fannie Mae and Freddie Mac have their own lending guidelines that every bank needs to adhere to sell their loans to Fannie or Freddie. But some banks create what they call overlays, which is where they incorporate their own rules on top of the rules that Fannie and Freddie have. And most of the overlays I'm seeing that some banks are coming out with are just in response to checking if people are still employed closer to the closing, which they normally were doing within 10 days anyways of closing. But some of the banks I'm seeing saying that they want to check within 1 or 2 days of closing in some circumstances, just to make sure that the person that's borrowing money was not furloughed from their job or laid off, to ensure that they're giving a loan to someone who's still employed and going to be able to make the payments. Outside of that, I'm seeing easement on appraisals. A lot of transactions where there's a decent amount of equity in the transaction. Both Fannie Mae and Freddie Mac use an automated underwriting system called either DU or LP, desktop underwriting, or loan prospector, and both of those are giving us a lot more appraisal waivers these days, so we don't need to have an appraisal done, or they ask for just an exterior appraisal, which keeps the appraiser from going into the property, for multiple reasons, for health concerns, and also just to alleviate to make the process easier during this time where we're all, trying to seclude ourselves from each other to keep everybody healthy. So I've actually found that in general, it makes it a little bit easier to get through the loan process now than prior, but it's the same rules, just tightened up a little bit. They're being more cautious, but at the same time easing on the appraisal side of things. So more cautious with employment and easier on appraisals. Overall, I'm not really seeing much of an impact, though, from the way I conduct business. It's business as usual for me for the most part.
That's true. As a matter of fact, today we just had a file said that the appraisal is waived. So I was like, well, that's pretty cool. It's not just like exterior appraisal, they actually waived it. So that's good to know. Next question is this a good time to buy more multifamily buildings? Neal.
Yeah, I'd like to take that because I want to contrast that with what was just said. On the multifamily side, our lending guidelines have changed, and they've had a much more significant impact than on the single family side. So if you're buying 5 or more units and it's a Fannie or Freddie loan, it's probably not a Fannie or Freddie loan for a 5 unit, but let's say it's a 50 unit, it probably is more likely that it is. They're now requiring us to keep a year's worth of mortgage, insurance, and taxes as impounds and give that to them when we're buying the property. That's a huge amount of money. If I'm buying a $20 million property, and I let's say before I was raising $6 million in equity, now I have to raise $7.2 million in equity. That is a big deal because it's harder to raise that extra money, and it reduces the returns for the investors. So the question was, is this a good time to buy more multifamily buildings? The answer is no, but I believe that by Q3, because of all these changes that they've made, there's going to be a number of multifamily buildings that will come to market at prices below what they were in February. So bottom line is, I believe that Q3 and some part of Q4 may be a good time to buy multifamily. For the moment, though, because the multifamily market, the commercial lending market, is seeing more of an upheaval than the single family market is, there's just isn't a lot of deal volume happening. A lot of 50-60% of the deals that were in the marketplace were retraded up to 5% price reduction. And as a result, a lot of people that were looking to put their property in the market have just simply decided to hold back. If they don't need to, they're holding back. So volume is going to fall in the multifamily market drastically in April, May, and June. So I really don't think you can buy anything today because there's not going to be much in the marketplace. But I think in Q3, some of the weaker buildings that were already in trouble before March are going to come to market at lower prices. So keep some powder dry, because I think that there's an opportunity there on the multifamily side, more so than the single family market, because I really haven't seen anything horrible happen in the single family market side that suggests to me that the prices will go down a lot.
Yeah, actually, as a matter of fact, we do see multiple offers still, believe it or not, although the offer price is going to be a lot more conservative, not bidding over and beyond the asking price, but we still have multiple offers, it's just below the asking price nowadays for single family side. Now, the thing is, actually, one question from me would be the 1031 exchangers, people who need to do 1031 exchange, then they have that 45 days, they have to buy some properties right now. I mean, what kind of advice would you give them to avoid multifamily, or what should they do?
Neal, before you say anything, let me jump in. It's not that they have 45 days to buy, it's 45 days
Identify,
to
sorry.
identify. A lot of because I have a couple of deals with 1031s right now, and the questions getting asked is they're going, are we going to get some relief on the backside of the 180 days? We haven't seen it yet. I'm sure there's, people back in Washington who are trying to pressure that. But we're talking about if we run out of time, because I've got a deal right now, and Neal made a lot of sense on this thing, is we haven't gone through a cycle yet where in April we don't know how many of the renters aren't going to pay their bills. We also, on multifamily, but let's say commercial space, same thing. We don't know how many of those tenants are going to pay or not.
Yeah.
The lenders are asking us to go find out before they decide if they're going to fund this loan or not. So we're in this kind of between period right now. And most of the feedback I've been getting is, we talked about in an exchange, is can we do something creative like at the last second and do a reverse exchange to buy time until the tenant situation, whether it's multifamily or not multifamily, stabilizes. And I don't know the answer to that, but it's something we're talking about, going, okay, how do we solve a problem before we run into it at the end?
Yeah, I resonate with what Marty said. I have to say, if it was my property and I was basically selling a single family and going into a multifamily today or over the next few months, I would think twice. I mean, I would think twice, because it's going to take a lot longer to close a deal. You can't do what people are doing on the single family side with 3D tours and video tours. That doesn't work for multifamily. It's very hard to do your appraisal, get your appraisal done, get your zoning done. The city's closed, getting closing done. Lenders are very slow. You have to ante up more money. And even with anteing up more money, the lenders basically are very hesitant to give you the same value for the loan that they were willing to give you a month ago. They think that the value of buildings is going down because the rents are going to go down, or the percentage of tenants that are paying is going down. So my advice for people is, if you haven't gone hard on a lot of money, you have to be careful at this point in time. It is going to be very, very tough. Like Marty, I believe that there's people in Washington working on potentially extending the 180-day time frame. There's a good chance that will happen. The question is, do you want to take that risk?
Yeah, exactly. And in terms of the seller side, and a lot of landlords, some of them, if they really, really have to sell for whatever reason it is, how can they maximize their values at this time, especially not knowing that they might have some non-paying rents because of COVID-19? Yeah, go ahead.
Is that a question for a single family landlord or a multifamily landlord? Because right now things are different. So on the multifamily side, if you've really got to sell, you've really got to sell. I think that the key thing is, on the multifamily side, if you're looking to sell, I would actually give preference to a 1031 investor, because in the last 30 days, non-1031 transactions, they had a very low close rate. Almost everybody pulled out. 1031 transactions, a huge percentage of them went through. Despite the challenges, they still went through. So to me, if I'm a seller, I only want to sell to 1031 people right now, even if I have to take less money.
Yeah, I agree. And Marty, do you have any thoughts about this?
Yeah, the only thing I would say is, I know obviously Neal is focused on multifamily, but what I'm seeing people do is they're starting to look at other property types now. They're looking at anything medically related because there's a big demand there. They're a little more excited about drugstores and supermarkets, et cetera. It's funny how 1 month ago we knew what we liked the best, and it's changed drastically. We've got a lot of changes coming. People feel that, you know, your Macy's, your Kohl's, your JCPenney's, et cetera, they're going to go, very good chance they may not survive this. But at the same time, that's that domino effect of whoever is the landlord for those is now going to have somebody coming in there aggressively trying to take a sublease in there, probably at 50%. And then they'll go ahead and somehow sneak back into retail, and it'll probably look like the store that was there before that went ahead and took all the expertise out of Macy's, for example. So it's a very interesting time, and how the dominoes are all going to fall, who knows at this point.
I actually have heard also other investors, they are basically renegotiating a lot of leases with some of their tenants, and they're slashing almost half of the rent amount just so that they can at least have tenants in the property. So that's some of the things that some of the multifamily owners are doing right now.
And they're kind of following up on that, Helen. One of the things that I'm hearing is going to happen from some of the groups that I talked to is they're expecting to avoid what happened in 2008, where the banks took back a lot of properties. They expect that the banks are going to renegotiate quite a few, restructure the debt, because they would much rather not devalue the properties by 50% and cause problem. So they're going to try to come up with some creative ways, at least that's what they're anticipating, to stretch it out so that the landlords can survive this as well.
Yeah, totally.
I think I wanted to point out that there are a number of interesting items in the marketplace. Some of the offices are also hard hit because their tenants are not working out. So there's people now talking about converting those offices to medical offices, because I think the supply for anything medical is going to be very high for the next 10 years. We saw anything related to security being a huge hit for 10 years after 9/11. So we're going to see the same sort of impact. So if you can buy small offices instead of buying a multifamily and convert those for medical office use, I think you have a winner.
Awesome, great. Last question for before the webinar is like, a property owner, if they've applied for forbearance, will there be any negative impact to their credits or approval in the future? Marty, do you see, or Daniel?
You know, I heard it's not going to do anything to affect the credit, but I don't know definitively yet. It may in the residential market, but I don't know in the commercial.
Same answer for multifamily. We do not know for sure.
On the residential side, what I'm told is that anybody that gets forbearance, because, and again, this is applicable to Fannie, Freddie, and government loans, that it will not have a negative impact on their credit, is what we're being told. That is, you know, that's essentially they're not going to show them having late payments or any kind of negative, anything negative on their credit to affect their ability to refinance or purchase in the future. But, you know, I don't know how it's going to work for jumbo loans or non-government backed loans. That's still to be found out.
Great. So let me move on to some Q&A that has been typed into the Q&A box. Kelly asks, are you concerned about California schools' announcement that they will be online this year only? I'm not quite sure what this question means, but I think for me, actually, when I heard about the California schools being closed, I was thinking that this is going to change how I work, how my husband work, because we have to be home now. And that means that a lot of people are going to have to change their work habit, which means that maybe office space will be much less desirable in terms of, you know, or office space pricing. Kelly, if you want to clarify your question, feel free to do so.
Yeah, my thought was just that if the schools are going to be closed, that probably means that we're going to be closed longer than we think we're going to be closed, right? So it's making me think that it's going to affect our market a little longer, that if they're expecting that no one's going to be able to go back to school until mid-June, when will these businesses reopen? So that was just kind of my thought.
Got it. I'm fully expecting until June myself.
I think at this point, the month of April is the hammer stage, and the month of May is going to be the hammer in some parts of the world and some parts of the U.S. and not other parts. I think it's going to be uneven. I believe that businesses will start to open at the beginning of June, though they're probably going to be flexible with employees in terms of work from home, given that their kids are home. So I think the impact there is not as huge as you might think, Kelly, at this point, because everyone's mentally adjusted to the fact that people are still working if they're at home. But you're going to start seeing some businesses open in California. There's no doubt that the San Francisco Bay Area is ahead on the curve of every other place in the US. And then California is ahead of every other state except for state of Washington. Our curve is bending the fastest. So I believe that we are going to be the first state that will go out of the hammer phase into the dance phase. And I think it'll happen at the end of May.
Fantastic. Thank you.
And Jenny asked, I wonder if anyone has heard if government will implement adjustments regarding capital gain tax law. Ooh, do we have CPA in here in this group?
I can say something I heard. Oh, go ahead.
Hi. The reason that I asked this question was if I did not do a 1031 exchange, obviously I'll still sell the property, and at that point I will be faced with capital gains tax. And given the fact that all these situations have altered so significantly, the government seems to be willing to help in almost every aspect. And I was just wondering if anyone has heard if government plans to do some tax relief for capital gains.
Great question. I
haven't heard anything.
Yeah.
So this is Kelly, and I actually do 1031 exchanges with our company API, and I have been checking in with them to find out whether any statutes have changed. They were expecting in the beginning that they would, and so far nothing has happened, so they're concerned that nothing is going to happen. So that was the last update I had. That was last Friday. So I haven't heard anything this week.
As a matter of fact, I actually did invite a CPA to join, but I don't think he's here right now. But I will ask him this question and see if he has any feedback, and I'll share with you, Jenny.
Okay, but could I just add another point? I wonder, would this be something that the real estate agent maybe proactively reach out to the government, just so that I'm sure there's more than just myself who's in this position where I've prepared so long to get this house sold, and now we're definitely having to face a different alternative path.
Yeah, actually, just to let you know that NAR, which is National Association of Realtors, they have been fighting so hard for our consumers, and part of the stimulus package actually included some of these that protecting our consumers. And in terms of the capital gains tax, I suspect, and maybe some of you guys can chime in as well, is that they're going to change more of the law on the rules on the 1031 exchange. Like, for example, we talked about the 45 days extension, maybe extending to a little bit longer. However, just we haven't heard anything yet, but it is definitely something that a lot of investors are thinking about right now.
Okay, thank you.
Sure.
This is Terrell. I have a question about commercial that maybe some of you guys can chime in on. Leslie Appleton Young, did a conference with our brokerage yesterday or day before, and she talked about potentially like long-term impact on commercial real estate. A lot of people are really accustomed using Zoom and go to webinar and WebEx, but most of us are kind of learning how to do that in the last week or two and have gotten pretty comfortable with it. And I think that their concern is, even when the dust clears, companies will realize, wow, we actually were quite effective with people working remotely, and maybe we need to keep doing that, and the demand for commercial space here in Silicon Valley is going to sort of let off quite a bit, and maybe that way into perpetuity. Are you getting a whiff of that? Or is that a concern, or what do you guys think about that?
I'm gonna bring in Mark Hinkins. Maybe Mark Hinkins, you can talk about it. But I actually just talked to a Southern California office commercial real estate agent, and he did say that he had some experience that some of their clients who were initially looking for office space, and then now they said like, well, it's okay, we don't need to have office space anymore. We can just work remotely. But I know Mark Hinkins, are you still on the line? You do work in the office space.
Yes, Helen, Mark is here.
Hi, Mark.
Hi. Yeah, interesting question. I think that the response from corporations as it relates to their office space, it's undecided as yet. I think what will happen is we'll see perhaps a shortening in the duration of lease commitments. Typically 5-10-year leases, 5 years being kind of the typical lease term. I think those days might pass. We'll start to see corporations looking at short lease terms, maybe 3 years in duration, 2-3-year leases, as they kind of figure out what the next steps are for them, and that'll be blended with co-working and co-sharing spaces. So I don't think there'll be an exodus away from office just now, but I think the practices will change, and I think we'll just see some shorter lease terms and a more kind of promoted work from home environment. But we still need to congregate in offices. We still need to be connected in person in our conference rooms. So I think we're okay, but I think it will certainly be the future will be different, but I don't think it's going to be drastic just now.
Yeah.
Helen, can I offer a different point of view on that? Over the last 5 years, a lot of the commercial office space in the US has been converted from cubicles and offices to open format space. Unfortunately, that tends to spread this disease in a very, very effective fashion. So I believe that the impact will be very substantial until we get to a vaccine, and then it will be what Mark says. But until we get to an actual vaccine, you're going to find people hesitating to work in open format offices. So I see a much greater short-term impact than a long-term, with long-term being whenever it is that we get to a vaccine being readily available. I think that then it goes towards what Mark says, where there could be, a shorter lease type of format.
That's true. That is absolutely true. Didn't really think about that. The open format actually helped the spread of the disease.
Yeah. Following up with what Neal said, because Neal, you had said you expect us to get back to work come June. I'm hesitant. I'm hesitant about that for the exact reason you just stated. Because until we get to a point where we can comfortably shake hands, hug, do whatever we do with humans, I'm wondering how much we get back to business as usual.
I think we're going to start figuring it out. And in my mind, China's going to help us. I think that, keep in mind that the countries that did the hammer phase before us, Italy, Iran, China, Hong Kong, are all going to work out the dance. Remember the dance? The reason why the dance phase is called the dance is it's delicate. You dance with the virus. It's not gone, it's here. You dance with it, but you can't let it turn into a monster, so you've got to be very careful. But I think that the realities of our economy remaining shut for more than a month, month and a half are so catastrophic that at that point, it will make sense to take some risks. And we're going to take we're going to have a number of months where we take this risk, and then we have a blow up in certain states or certain cities. Oh, Houston has another blow up, so now Houston goes back into quarantine for 15 days. We cancel all the flights there. The rest of the United States continues, and then 2 weeks later, it's a different city. That's going to happen. That dance phase cannot be avoided. but we can't just not run the economy. If you do that for more than a few months, we're going to end up in a massive depression. And I think the Federal Reserve knows that. The president certainly seems to be very tuned into it.
Yeah, we'll know more in about 2 weeks, I think. That'll tell us.
Yeah, I think so.
All right. I'm turning my camera for the Facebook Live so people actually can see you guys instead of just staring at my face. All right. What's the next question? Do you think that now shelter in place is extended, will the eviction moratorium also be extended? Ooh.
Makes sense. I mean,
yeah.
If the question is, shelter in place was only extended nationally. I mean, we don't have a shelter in place nationally. We have a state by state shelter in place. I think it's only really extended until April 30th. So that's not a huge amount of time. We're not talking about a number of months there. But if shelter in place is extended to May, which is very likely, then I think that the moratorium will be extended to May as well. I think the moratorium stops whenever shelter in place stops.
Absolutely. And actually one thing is quite interesting is that when I was reading about the eviction or the rent abatement, like allowing up to 120 days, but at the same time for the mortgage moratorium, they only allow up to, is it 60 days or 90 days? Oh, sorry, 30 days at a time, and then extension until 90 days, which is shorter than what they allow for the tenants. So in a way, it's going to be a huge impact to the landlords as well.
I don't think there's a way to avoid impact to landlords. I mean, this is a big bam to the face. I mean, and I think that net, if we come out with no income for this year and no losses, I'm not, I'll be okay with that. I know that sounds horrible, but I'd be okay with that, because that would we would have essentially written off 2020 as an income year for our properties. As long as I don't lose my properties, I'm okay with that. So there's no way to sugarcoat the fact that this is going to hurt the landlords big time.
You're absolutely right. We cannot try to paint this like really optimistic future for landlords, but at the same time, there is some stimulus package that is helping us as well. I actually wanted to ask, I remember there was a question regarding the stimulus package helping a lot of different small business owners, but what about real estate investors and also real estate developers? Whether any of those stimulus package can help investors and developers?
I think the biggest impact is simply that tenants are getting money into their hands. Yeah. And that is a huge, huge benefit for us. There's a lot of real estate companies that are going to apply for the $10,000 grant. We're going to apply for the $10,000 grant because our revenue is reducing. There's going to be a lot of people that will apply for the PPP loans, which is the basically the money that you get from the government for keeping your people on staff. Mm-hmm. So real estate benefits from not having to let go of people because they're getting this money from the government, which I think is a loan and can then turn into a forgiveness. So we're going to benefit. And in my mind, I can't think of any sector of the economy that has benefited as much from the $2 trillion bill as landlords, because we all know this, that the first thing that people think about when they get this money is food. Used to be that rent was second. Now, of course, it's food, then Netflix, then rent. So luckily, Netflix is $10. So after that, it's still going to be rent. So we're still going to be an immediate and direct beneficiary. I can't imagine that instead of somebody thinking I'm going to pay rent, somebody's going to say, oh, I'm going to go and rent an Airbnb, or I'm going to go and spend $2,000 on a party for my kid, graduation party. Rent comes first. Right? So we are a bigger beneficiary than somebody going out and spending money that is a discretionary income. I don't think people do discretionary stuff for a few months after the dance begins.
Yeah.
Well, I'd like to comment on that, Helen, because Neal, you invest out of state quite a bit. I think if we take kind of the microcosm of Santa Clara County, just because there's a lot of people here, I mean, rents here are going to be, they're $3,000 plus a month, right? And many of those people that are in those types of apartments right now, they're not going to get the $1,200, which doesn't cover much for people in California. So I'm not so sure what I'm going to call the mom and pop investor is getting that much from the stimulus package. I think they are vulnerable to this. I think some of them may not have enough reserves for as long as their tenants choose not to pay, and that's going to create some major challenges. The other sector that's also, I mean, both construction and existing hotels, I mean, these guys are hanging on by a thread. And so there's a lot more to this than just multifamily, and the domino effects are quite interesting and scary, can't it?
I agree. Everything that you said, I agree. And I have to say that, Helen, I mean, what Marty said makes me rethink my comment about potentially California not seeing as much of a challenge, because I'm used to in my properties, the average tenant pays $950 in rent. So to them, if a family of 4 gets $3,400, that's a big freaking deal, right? He can pay 2 months of rent and still buy $1,400 worth of food. Where in California, that person is living in a property and paying, $2,000 or $3,000 in rent. So perhaps the impact on California could be stronger.
Yeah, absolutely. Yeah, actually, I mean, also there are a lot of small business owners who may be making more than $75,000 or $99,000 a year, and now they're making almost nothing. So unfortunately, they're not getting anything either out of this. Now, next question. I have heard that banks anticipate to mortgage rate drop in the next few weeks, leading to the end of this year. Is this accurate? Daniel, have you heard mortgage rate going to be dropping?
Yeah, that is a very weighted question in this current market, because it's almost, I'm going to admit that this is over my head, the complexity of what's going on. So there is, the government stepped in and said, hey, we're going to buy, first they said $50 billion in mortgage-backed securities daily, which should have been an immensely great thing for the mortgage market. But banks, what they do on the back end is when you lock a loan, that's not the day that they actually, that's not the day they're selling the loan. So when you lock a loan, let's say you lock a loan at 3.5% interest rate. What the bank does is they invest money hedging against if rates are going to go higher. So they short their position. And then what happens is when the Fed comes in and buys all these mortgage-backed securities, they get caught up on their shorts, and their lines, they start getting margin calls on their lines of credit. And again, this is literally beyond my knowledge base, because I try to focus on knowing guidelines, how to close a loan, not knowing really the back end of how this works, but I'm trying to learn it because I find it interesting now. I've never needed to know much about it, but now it's all of a sudden I'm trying to see why are rates doing what they're doing. And it's interesting because if you look at base conforming rates for residential, which is loans nationwide up to $510,400. I'm seeing rates in the low 3s right now, all day long, every day, and it's very easy to get very good rates. But then when you step into what they call high balance conforming loans, which are loan amounts that are based on county, depending on what county you are, anywhere in the United States, they have different limits. Let's just say for most of California, because it's considered high cost area, you have loan amounts that go up to $765,600, and the loans that fit between that 510,400 number and the 765 number, there has been a lot of. It's been, to be honest with you, the only way I can describe it, it's a bit of a mess right now. You have most of the banks, and I work with about 30 banks I broker to, and I'm a direct lender. So most of the banks I work with do not have very competitive pricing right now for that level of loan. There's a few that do, and I try to understand why. It has something to do with the way they sell those loans. They can only have 10% of their portfolio be those high balance loans versus 90% needs to be the base conforming loans. So there's a lot of volatility within the rate market, but I think that some key players in the mortgage industry have been talking up this issue, what's happening on the back end with the mortgage-backed security purchases. The Fed is actually listening. They're slowing down their purchases so that they can create more stability in the mortgage market. My anticipation, which, by the way, nothing makes a lot of sense right now, because I could have told you a month ago, the easiest way to tell what mortgage rates are going to be is look at the 10-year Treasury yield, add maybe 2% at most, and that's where interest rates are. So that would mean right now 30-year fixed rates should be in the 2s. They're nowhere near that, though. I mean, on average, they're in the low 3s for the base conforming, and they range all the way up to the low 4s, depending on what your exact scenario is. But since there's no economic indicator that has worked for 20, 30 years previously that is working currently to show you where rates should be, it's a tough question to answer, but my anticipation is that with the work from the Fed slowing down the purchase of mortgage-backed securities, but still being involved in the market, I think we'll see some stabilization of rates in the next 2 to 3, maybe 4 weeks. But right now, we're still in a volatile area at this point. So I see some banks offering great rates one day, and the very next day, the rate sheet comes out, and it's a completely different story. So it's really bank to bank, and I think this is really one of the advantages of being a broker is that I don't have just one option, and I can shop around and see which of the 20 or 30 banks I work with, which one wants to actually be in business today and which ones don't, and it changes day to day.
Well, we know obviously a lot of people already think that the Fed is going to keep the rate low for as long as possible to keep the economy going. Just like what you're saying, we just don't know about the mortgage rate. I thought a couple of weeks ago, before this shelter in place, I was going to refinance my home, and we are with a VA loan, so it's like 2.75 for 30 years, and it was amazing. I was so excited. And the day that I started and the rate just kind of shot up, and I was like, whoa, what just happened? But I thought the rate will come down because of the economy, but it hasn't come down to where I want it to be again. So yeah, I agree with you, Daniel. It's just really hard to say right now at this time. I
was just going to piggyback on that government loans like FHA and VA, they actually still do have some pretty amazing options. Like I'm looking at a rate sheet right now for FHA loans. Somebody getting, again, up to $510,000, I'm seeing like 3 1/8% with 0 points for an FHA loan. There are still some amazing rates on the government loans, but again, it's the same thing for VA and FHA. It seems to be only up to that $510,400 limit. Above that, there's a lot more volatility in the market.
Mm-hmm. All right. I'm wondering, I want to see if anyone else want to ask a question. I know some people, I thought somebody wanted to ask a question. I don't know how to unmute yourself. Is there any questions that you guys want to ask? I know we have property manager, I think we have a 1031 exchange person, we have title, and we have a lot of real estate agent from different markets, including San Francisco, and yeah. Jenny, did you want to ask a question?
I have a question. How do I get a recording of this? Because this was a terrific, event that was California focused. All of the stuff that I've been doing, I've had, people on from all 50 states in my webinars. This is more a California centric audience. I'd love to get a copy of this recording.
Absolutely. I'm going to actually upload it on YouTube, and I'll definitely send it to you.
Fantastic.
Can we have some sort of document we all sign? Because I'm not comfortable with Neal having my information.
Well, I think the main takeaway of Marty there was the hair. I mean, that was the
How's it look?
Yeah, it's great. My wife indicated that if I shave it off, there may be a divorce coming. So we'll see what happens there.
This explains a lot, Neal. Now I understand a few things in my own life. Okay.
Oh, actually, there is one question. I understand that the directive regarding foreclosure relief for enterprise-backed mortgages is for single-family homes only, not multifamily or commercial. Is that correct?
Technically, yes, but you can get a sheriff anywhere in the U.S. to come out and evict people. So why does the law matter? There is no current sheriff's department in the U.S. accepting applications for single family or multifamily. So
that is true.
Doesn't matter.
Yeah, I for my own buildings, we have tenants that we've tried to evict before this whole thing happened, and then now they are just waiting. They're like, oh, nobody's gonna come in and evict me anyways. All the court date get postponed, so nothing.
The courts are closed.
Yes, exactly. So everything is not really postponed. It's like you just don't even know.
Yeah, I mean, the courts are open for other things. I mean, you can't even get your eviction on a court docket right now. Simply like Amazon, like I wanted to buy a doodad yesterday from Amazon, and the shipping date was April 23rd for Amazon. Same thing's happening. The courts are prioritizing other things that they need to do right now. They're just not allowing anything eviction related on the docket. We've already tried in Georgia, which is usually a very, very landlord friendly state. They're not even, they're like, don't even call us. We're not going to process your paperwork, so don't bother.
Yep. And I want to maybe share a little bit of our experience as like a real estate broker, where we do transactions every day. We talk to clients every single day. And I think naturally we all think that, okay, real estate market right now is basically halted. Nothing is going on. But as a matter of fact, we still see a lot of off-market listings. And because MLS is allowing us to pause the days in the market, but a lot of sellers are really nervous, saying like, hey, let's not put it on the market right now. Let's like hold off until this shelter in place is lifted. Then, but those people who actually put it on the market, they still get people to do showings. So most importantly, you have to do a virtual showing first. Once you do the virtual showing and allowing people to see it on the computer, the people that actually go to your property and see, they're very serious buyer. So I would still recommend sellers, if you need to sell, don't wait. Honestly, I don't know when this shelter in place is going to get lifted. I personally have a feeling that it's going to probably get extended a little bit more. So just make sure that you do virtual showings, you do the 3D tours, and continue to work with buyers who are very serious. There are still buyers. Demand is still there. Right before this shelter in place happened, we look at open houses. We still have so many people looking. Those people, some of them, of course, they cannot buy anymore because of the down payment, it's been tied to the stock market, but their initial needs is buying. So, and I don't know if you guys agree with me, Neal, maybe you can also chime in regarding Bay Area market. I just feel like the technology side is more important than ever because of this shelter in place. So a lot of these technology companies in the Bay Area, actually, they're doing okay. And only the people who are in like corporate jobs, honestly, can't afford to buy real estate here since everything's over $1 million. So yeah, maybe you can share with us.
I don't think there's been a lot of white collar people laid off. I think most of the people laid off are blue collar workers. Those blue collar workers haven't bought a property in the Bay Area in the last 10 years.
Yeah.
So the people that are capable of buying properties are not laid off. You can go to E-Trade or go to Yahoo and you'll notice that the NASDAQ is doing better than the S&P 500 and the Dow. What that means in common English is that technology industries are faring better in this downturn because it is so much easier for them to work remotely than, let's say, a construction industry. How do you work remotely in the construction industry, right? Well, you can work remotely in the technology industry, and the Bay Area is tech heavy and biotech heavy. Both tech and biotech can work from home. And so I think that right now, there's an even smaller recognition of how good this is for technology. If you look at the stocks that have done really, really well compared to the market, Microsoft, Zoom, I mean, these are the stocks that are overperforming. And there's very few technology stocks that are overperforming. So it's clear that tech actually is going to do well in this particular recession.
Yeah, I absolutely agree with you. Well, we are 1 minute before 3. If there's no other questions, I want to say thank you to our panelists. And I'm going to go back to my screen real quick to share with you. Here we go. Okay. So these are the special speakers that we had today. I want to say thank you again to Neal, Bawa, Marty, Lefton, Daniel, Gad, and myself, of course. Thank you so much for your expertise, and also all the audience, everybody participated. I'm really excited about this. I think it is an important platform for people to share their knowledge and also ask their questions. So hopefully you guys can come back next Wednesday, and then if you have any feedback, feel free to let me know. And these are all the contact information here. So feel free to connect with one of us. All right, so I guess that's it. Again, thank you, and everybody stay safe.
Thank you.
Thanks, Helen. Take care.
Bye.